In today's episode, I'll talk about three very interesting stories. In the first story of the day, I'll talk about real estate and the surprising revival of the Indian residential real estate sector. In the second story of the day, I'll talk about why SEBI has instructed one of India's largest REITs to suspend its CEO. And in the third and final story of the day, I'll talk about SEBI's new rules for NFOs. Welcome to the Daily Brief Show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 6th of November. By the way, this is a very special episode because today we complete 100 episodes of the Daily Brief Show. A lot of hard work, late nights, and sweat has gone into building this show, and we are so grateful that all of y'all have ended up loving it. Hopefully, we'll keep touching such great milestones going forward. That said, let's start with the first story of the day and talk about the surprising revival of the Indian residential real estate sector. See, this sector has faced a lot of challenges in the last few years, but it is now suddenly bouncing back. Not too long ago, things were looking very rough in this space. There were too many unsold homes sitting in the market, people were very hesitant to buy property, and lenders did not quite feel secure about offering loans. It seemed like the industry had hit a rough patch of sorts, but things took a very sharp turn after the pandemic. To explain how much things have changed exactly, let's look at inventory levels, which is a crucial measure in real estate which tells us how long it would take to sell all the unsold homes in the current sales rate. Now earlier on, this figure was over 30 months, which means that it would take more than 2 years to sell off all the available homes. Today that number has gone down to 18 months, and experts even believe that it could go further down to about 15 months within just the next 2 years or so. Now this dramatic change signals that homes are now selling faster, which shows a stronger demand and a much healthier market overall. Now this recovery becomes even more interesting when you consider the global environment overall. See, despite economic worries including the likes of inflation, rising prices, and the tensions in places like Ukraine and the Middle East, India's real estate market has managed to stay very strong. The Reserve Bank of India has been holding the repo rate steady at 6.5%. They've kept this rate the same for 10 rounds now, which could mean that they're thinking about lowering it by the second half of 2025. Now, if rates do go down, it could further encourage home buying, which could be a big boost to the industry. Now, one big factor driving this revival is the Real Estate Regulatory Authority, or the RERA. Now, this was a law that was introduced in order to bring more transparency into the market. RERA or RERA introduced strict regulations which pushed out many smaller and less stable players, which led to market consolidation, so to speak. Today, larger players dominate this area with over 70% of their bookings happening during the early stages of construction itself. On the other hand, smaller developers have to wait until their projects are nearly completed to get even half of their bookings. This change in market dynamics is creating a more reliable, stable industry where customers can feel more secure about their purchases. Now, beyond all of this, another big shift that we are seeing today is in what home buyers actually want. See, earlier, affordable housing, so to speak, ruled the market. It accounted for more than 40% of new projects back in 2017. But today, this figure has dropped to below 20% as people are moving towards premium and luxury housing options. In fact, premium and luxury projects have doubled from 10% to over 20% of new launches. You might ask why this shift? That is because consumers are today looking at homes that offer more than just basic shelter. Buyers today want larger spaces, dedicated work areas, smart home technologies, and eco-friendly features as well. These preferences indicate that people are willing to pay a premium for comfort, convenience, as well as sustainability. In 2023, property prices rose by about 8% across the entire country. Cities like Hyderabad, Bangalore, Gurgaon, etc. saw the highest increases amongst all. Analysts expect this trend to continue, and they project about a 7 to 10% rise in 2024 as well. Now, while we're also analyzing, it's probably also a good idea to understand the financial health of major players in this sector. See, in the financial year of 2024, top real estate companies achieved impressive pre-sales of over 1 lakh crore rupees, which marked a growth of 36% compared to the previous year. Collections, which is the money that developers receive from these pre-sales, almost doubled from 30,000 crore rupees in FY19 to over 67,000 crore rupees in FY 2024. Another positive trend over here is that many real estate companies are reducing their debt slowly. Their collective debt went down from around 50,000 crore rupees in FY19 to about 44,000 crore rupees in FY 2024. This is a part of a shift towards an asset-light model, which means developers are focusing on projects which require fewer resources and an avoidance of taking on excessive loans. This approach is helping them maintain stronger and more stable balance sheets. Now, looking ahead as well, there are several factors which suggest continued growth in this industry. For one, India is heavily investing in infrastructure. Public capital spending has risen from 1.7% of GDP in FY 2014 to 3.4% in FY 2024. This means that the government has allocated over 11 lakh crore rupees in the FY 2024 budget for infrastructure, which is triple the amount that they spent in 2019. These funds are going into building expressways, airports, metro systems, and other major projects which create new areas for real estate development and also raises property values as a result of it. Another factor driving this is the growth of Global Capability Centers or GCCs. This is more prevalent in southern cities of India like Bangalore and Chennai. See, GCCs are large corporate setups that global companies establish in places with a talented workforce. These centers basically create jobs, which in turn increases the demand for housing in those specific areas. But all said and done, it's probably not as smooth sailing as it may sound so far. See, rising property prices combined with high interest rates could make homes a little less affordable, particularly for first-time buyers. Additionally, if the IT sector, which has been a big driver of demand in tech-centric cities, slows down on hiring, it could very heavily impact housing demand in those very areas. Looking at 2025, some experts are predicting further growth. They are saying pre-sales and collections can reach 1,30,000 crore rupees and 80,000 crore rupees respectively, which is a 15 to 20% increase over FY 2024. But for this momentum to sustain, developers will need to keep an eye on real demand and avoid oversupplying the market. So in summary, India's real estate is seeing a very strong comeback right now after the pandemic. It is driven by faster inventory turnover, regulatory improvements, and changing consumer preferences. There are definitely some headwinds to watch out for. The combination of financial discipline by developers and infrastructure investments by the government offers a promising outlook for this sector overall. The next couple of years will definitely be crucial as this sector tries to balance growth with affordability, and they also navigate both opportunities as well as challenges in this space. With that, let's move on to the second story of the day, which also to some extent is related to real estate. Look, recently, SEBI instructed Embassy Office Parks REIT, which is one of India's largest real estate investment trusts or REITs, to suspend its CEO Arvind Maiya. SEBI's reason here is that they are unsure if Maiya meets the fit and proper standard required to lead a public company handling investor funds. The backstory is that the National Financial Reporting Authority, or the NFRA, which is India's accounting regulator, recently banned Maiya from audit work for 10 years. This ban was due to alleged lapses in his role as an audit partner for Coffee Day Enterprises or CDEL in 2019, where significant financial issues were not flagged under his radar. NFRA fined Maiya 50 lakh rupees claiming that he missed critical warnings about CDEL's undisclosed fund transfers. SEBI is now questioning if someone with such regulatory history should even manage public funds. For SEBI, fit and proper means having a spotless record, especially in high-stake roles like REIT leadership. Embassy, however, is arguing that audit work and management are a little different. They believe that Maiya has done pretty well since he joined and that the fit and proper standard applies to the REIT and not specifically to its CEO. Under pressure from SEBI, Embassy has now announced that Maiya will transition from a CEO role to the head of strategy, with other board members stepping in to manage operations. Technically speaking, Embassy faces a bit of a choice dilemma right now. They can either replace Maiya as the SEBI is advising, or they could challenge SEBI's decision, though pushing back could invite more scrutiny and trouble for them. Now over here, SEBI's very firm stance signals that they will just not compromise on leadership standards, especially for roles managing public money. But on that note, let's switch to the banking sector and talk about a long-standing issue between loan and deposit growth. See, over the past few years, India's banks were lending faster than deposits were coming in, which were creating a credit deposit gap. Now, this is very risky because it makes banks vulnerable to liquidity issues if too many loans go unpaid or if there is a sudden surge in withdrawals. Now, this gap started growing after the COVID-19 lockdowns were lifted, when spending suddenly surged and led to a credit growth rate of 16.4% year-on-year by late 2024. Meanwhile, deposit growth was only at about 9.2%. Banks were lending 130 rupees for every 100 rupees in deposits, which is a precarious position, so to speak. The RBI stepped in over here and took several steps to cool off lending and encourage deposits. I'll talk about three of those things today. First is the interest rate strategy. Look, by keeping interest rates high, the RBI made loans more expensive. This discouraged people from taking out loans as readily, which slowed down the rate of credit growth. But on the flip side, higher interest rates are also making saving money a little more attractive, which helps boost deposits. The second is higher risk weightings. RBI introduced higher risk weightings for consumer loans and loans to non-banking financial companies or NBFCs, meaning that banks had to set aside more funds whenever they wanted to lend to these segments. This increased the cost for banks to lend in areas like consumer loans and encouraged them to be a little more cautious. The third one is new liquidity norms. Look, RBI implemented stricter liquidity coverage ratios or LCR norms. This required banks to hold more liquid assets to cover any unexpected cash outflows. By boosting liquidity requirements, the RBI ensured that banks would be in a better position to meet withdrawal demands at any point in time. Now, thanks to RBI's efforts, the credit to deposit ratio has come down recently. It currently sits at about 79.6%, which while is still a little elevated, is a lot more stable than previous quarters. Analysts are believing that this rebalancing will make the financial system a lot more healthier and could also pave the way for a rate cut if deposit growth continues to outpace credit growth. To give you an overall picture, the RBI's actions have, so to speak, restored some level of stability, and the banking system is now in a much better position to move forward. Let's now move on to the third and the final story of the day and talk about SEBI's new rules for mutual funds to address delays in how they handled NFOs or new fund offerings. Let's understand what's happening exactly, but before doing that, for those of you who do not know, let's understand what exactly an NFO is in the first place. Look, when a mutual fund company wants to introduce a new fund into the market, they announce something that is called the new fund offering or the NFO. Now, this is very similar to how new companies offer an IPO or an initial public offering when they want to raise money from the public. Now, with an NFO, AMC collects money from investors and they promise them to invest it according to a specific strategy, like in large cap stocks, mid cap stocks, or in government bonds for that matter. Today, when people invest in NFOs, they expect that the money that they will put in will be invested quickly and according to the fund's stated plan. But here is where SEBI's concern comes in. SEBI has noticed that in some cases it is taking months before all the collected funds get invested in the right assets as promised by the fund strategy. Now, to understand why exactly this matters, let's look at an example. Imagine there is a mutual fund company called XYZ AMC and they launch a new fund that is focused on large cap stocks. Imagine the NFO goes well and they manage to raise about 5,000 crore rupees from investors. But instead of investing this money in large cap stocks right away, they park it in safer, low return instruments like government bonds or treasury bills. Why? Because they're probably waiting for what they might think may be a better time to enter the stock market. But the catch here is that this delay means that investors are missing out on potential stock market gains while their money is now just sitting idle in safer and lower yield investments. Now, if the fund strategy is to invest in large cap stocks, then keeping funds in low risk government securities means investors are not quite getting the returns they signed up for. So in short, this lag could hurt investors who put in their hard earned money with the expectation of higher returns from stocks. Now, with collections in new mutual fund schemes hitting record highs recently, SEBI has stepped in to address this very problem. In 2023 alone, these new schemes raised a whopping 63,800 crore rupees. And in 2024, this very total has already crossed 94,000 crore rupees with a couple of months still left in the year. By any stretch of imagine, that is a massive amount of money, and SEBI wants to ensure that it is invested promptly so that investors do not lose out. So to address this, SEBI has now proposed a strict timeline for AMCs. Specifically, SEBI suggests that AMCs must invest all funds collected during an NFO within 30 days from the date they allot the fund units to the investors. In some exceptional cases, maybe due to unusual market conditions or something, SEBI could allow a 30-day extension which gives AMCs a total of 60 days to deploy funds. But that's it, no more than 60 days under any circumstances whatsoever. Currently, the rules around NFOs are mostly limited to how long these offerings can stay open. As it stands, an NFO cannot stay open for more than 15 days, which means the AMC has only 2 weeks or so to gather investments before it must close the NFO. But there is no specific rule about how soon these collected funds must be deployed according to the fund's investment plan. The only rule so far allows AMCs to temporarily park these funds in low-risk government securities during the NFO period. But SEBI's data shows that a majority of AMCs are already able to deploy their funds fairly quickly. In fact, SEBI reviewed NFOs over the last 3 years and found out that of 647 NFOs, 603 were able to successfully invest funds within 30 days of allotment. Now, if we extend this period to 60 days, nearly all, to be precise, 633 of these NFOs managed to deploy funds, which covers 98% of all cases. So based on these numbers, SEBI is saying that there is really no strong reason for AMCs to need more than 30 or 60 days. Delaying further just does not hurt investor returns. It also means that AMCs are not acting in the best interests of their investors. Now, with that out of the way, you might be wondering what exactly happens if AMCs do not stick to this timeline? Look, SEBI is not just making a suggestion here, they are proposing some very strong consequences for AMCs that do not comply with it. First, AMCs could lose the ability to launch new schemes if they repeatedly fail to deploy funds on time. This is a big deal for AMCs because new fund launches are an essential part of their business model. In addition to this, SEBI might require AMCs to waive off exit loads if they have not invested on time. By waiving these fees, SEBI is giving investors the freedom to exit without any penalties if they feel that their money is not being used as it was promised. This could potentially hurt AMC business models and reputation as well, as investors might avoid funds with a history of delays in fund deployment. So through this proposal, SEBI is essentially telling AMCs to be more responsible about how they handle investors' money. If the market conditions are not quite ideal, SEBI is suggesting that AMCs should consider moderating how much they raise in the NFO rather than holding on to funds for long periods of time. So simply put, SEBI wants AMCs to be mindful that holding on to cash for too long goes against what's fair for investors. Now, this move is a part of a broader trend of SEBI enforcing transparency and fairness in India's growing mutual fund industry, especially as the stakes get higher with record-breaking fund collections every single year. So if SEBI's proposal does go through, investors can expect their money to be put into work much faster when they invest in a new fund offering, aligning with the purpose and the potential returns that they were promised. Let's now move on to the final section of the day, which is the small news tidbits. First, JSW is in talks with Haier for a joint venture in consumer electronics. This could potentially boost India's local manufacturing. Facing regulatory restrictions, Haier may cede majority control, making a strategic move to enter the Indian market amidst growing competition. Second, Hero Electronics plans to sell 25 to 30% stake in semiconductor firm Tessolve and aims to raise 120 to 150 million US dollars. Now, this aligns with India's expanding semiconductor industry, with Tessolve serving about 80% of top global semiconductor clients and is expected to grow even further with investor backing. Third, diesel sales in India are slowing down, with October sales flat and year-to-date growth at just 1.8%. Shifting consumer preferences and seasonal factors are driving a tilt towards gasoline, which is signaling evolving energy consumption trends in India. Fourth, Vanguard has cut Ola's valuation to $2 billion US dollars from a peak of $7.3 billion US dollars. Now, this has raised investor caution as the company is getting ready for an IPO. With mounting competition and financial challenges, Ola's IPO journey is expected to face heightened scrutiny. That's all the news and stories I have for you today. I hope you found value in today's episode. Thank you so much for watching. We would love to know your thoughts in the comments down below, so please do share it. This is your host Anurag Bansal signing off. I'll see you tomorrow. Goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.